Hello, everyone. Welcome to another episode of Prime Venture Partners podcast. This is your host, Shikhar. So, today we are introducing a new format based on your feedback. We will be answering your questions. We asked you to share your burning questions about startups and entrepreneurship. And of the many received, we have handpicked a few. And if you do have an unanswered question, email me at shikhar@primeview.in and we'll answer them in future episodes. So today, I have with me two partners at Prime who will be answering these questions, Amit and Sanjay. Welcome to the show, guys. So I'll pick the first question that people have asked. That was, in the current conservative times, do VCs feel comfortable investing in pre-revenue companies? And if yes, what is the evaluation framework used to identify such a company?
Hi, everyone. This is Sanjay. Let me take a stab at that. At Prime, of course, we are an early stage investor. And so we are very comfortable in general investing in pre-revenue companies. But broadly, I think, we look at 5 areas. Clearly, we look at the team itself and their experience, expertise, passion for solving the particular problem that they've chosen. Team, TAM, timing, product, and differentiation. I think those end up being sort of the biggest dimensions on which we evaluate the opportunity. And if the team is outstanding in terms of its expertise, in terms of its passion, understanding of the problem, if the problem seems large enough that it's worth building a solution for, this, of course, has to be validated with a lot of discussions with prospective customers. If the timing feels right, where some, I would say, non-linear change has happened to either at the technology level or the adoption of technology that feels like the timing might just be around the corner. And if the team has a really deep sort of understanding of what product differentiation should look like, how they perhaps could, maybe they've built prototypes, or maybe they've got customers who are doing pilots, although these might not be paid pilots. I think these are the 4 or 5 things we look for. And ultimately, if we feel there is an opportunity for a step function transformation of a very large industry, we are very happy to jump in with both feet and partner with such founders.
Got it. Thanks, Sanjay. Amit would love to hear your thoughts as well.
Yeah, so just to add on to what Sanjay said, one of the things we look for a lot and would encourage a lot of early stage founders to think about is really getting deep understanding of the customers. So revenue is the ultimate proxy for that. But even short of that, like if you've spent time in that area, working in that area, building for that area, or meeting dozens, if not, then maybe, if not hundreds of customers, then that comes out quite clearly when you're, pitching investors or you're doing your early build or trying to get to PMF. So spend a lot of time on customer discovery before you pitch, especially if you're doing a pre-revenue stage startup, because that serves as a good proxy for your understanding the market.
Got it. Thanks. So next, move on to the next question. So why do VCs seem to care about competition, and how should one respond to the investors about competition?
Sure. So I think Peter Thiel has written this amazing book called 0 to 1. And in fact, there is a very provocative quote in there saying competition is for losers. I don't think competition is for losers. Competition proves that there is a large enough market with a real problem that customers are willing to pay for. And often this is also called like a red ocean market, right? That there's a lot of demand, but there's a lot of competition, and therefore there'll be a lot of cost of customer acquisition. You'll have a lot of feature differentiation, etc. So I think there are plenty of good companies that are built in quote unquote red oceans, right? Which is that, big market, big customer pool. How do you solve for that? So you obviously have to have a much better mousetrap, right? A much better solution, and some secret sauce on distribution and customer traction and customer love. On the flip side, and again, this is the kind of companies we love at Prime Ventures, is there are blue ocean startups where you're imagining something new, right? Obviously, there has to be some proxy for customer demand, but where you're imagining a new way of doing things, where you're imagining a new solution, perhaps to an age-old problem. It's not like problems are new, right? Problems are, age-old problems for businesses or of consumers. So I think it is very important because for venture investor, they're not investing for like an equity investor for 6 months or a year or even 2 years. We're investing for 8 to 10 years, maybe longer. And therefore, it is very important for us to realize whether the team that you have and the problem statement and the area that you're working on is something that you can build defensively over a long period of time, right? So both defensibility and differentiation are really, really critical. So anyway, I would encourage you to think very strongly about, why is it that you're unique and different? And is it, more importantly, relevant to the customer segment that you're trying to solve for?
Good. So from competition to culture, so next question is, how do you figure out culture for a startup, and what is a good time to think about it?
So, culture is defined by, what the 10th employee or the 50th employee or the 500th employee in your startup experiences culture is, right? So it's not defined by what you, the founder, or the, CXO or the founder -1 says what it is. So it has to be done very conscientiously, very deliberately, very thoughtfully. And obviously, as a young early stage founder, you're just worried about survivability and about making money or revenue, or about fundraising, or about getting to product market fit. So it's often an afterthought. And what we have learned after backing companies for over 10 years and having some great successes is that the best founders think about culture consciously, deliberately, and constantly, right? So you have to first define what your culture is, which is to say, how do decisions get made, what gets rewarded, what gets reprimanded, how people get hired, how people get fired, whatever, what have you. And then, discuss and debate with the organization if they feel like that's exactly how it is or it isn't, and involve your employees, no matter how small the team is. And then over time, you have to evolve the culture. It's not to say that it's like the Constitution or Bill of Rights that you made it once and it's never going to change. Culture is a living document, but I think the core tenets of how you behave with people, how you behave with customers, how you deal with investors, how do you deal with innovation, most of those things, at least in our observation, doesn't change all that much, right? It evolves nominally. So my recommendation is think about it earlier, way earlier than later, number one. And number two, be conscious and deliberate about it, and be transparent about it, and talk to your investors, talk to your founders, other employees, talk to potentially even other peers as you go about building and expressing your culture.
Got it. And even constitutions don't remain constant. There are amendments and there are new bills introduced. I think culture is a dynamic thing.
Great point, Shikhar.
Yeah. So next, from culture to opportunities. So can startups be about creating new opportunities as opposed to solving current problems?
So I think people would like to believe that that is the case. For the most part, we have found that there is a problem, a new solution might emerge to this problem, right? And so if you take an example of a company like MyGate, technology reached a certain level of adoption and maturity where a smartphone could be used by a security guard at the gate and by all residents, and that transformed that industry from a paper register and an intercom to a smartphone-based real-time dynamic application, which then leads to a lot more possibilities, right? So that was a case where it was creating a new category of solutions to a problem that had never been solved in that particular way, but the problem did exist in its own right. I'll give another example of a company in our portfolio, which is Dozy, that is doing remote vitals monitoring and also measuring blood pressure in a contactless manner. That is the first time something like that has been done anywhere on the planet. But it's not like people didn't realize that they needed an easy way to measure blood pressure. It's just that technology-wise, it was not possible in a contactless manner, right? And that's the only thing that makes it practical. So every now and then you will run into these step function transformations or leaps that happen in technology. And obviously the smartphone has been a big catalyst in that. That has made certain types of solutions to problems possible. Right. And so it might appear that, you're creating a new opportunity, but really it's some major shift happened that made hitherto, impossible solutions suddenly viable and practical. And so generally my feeling is those are sort of what we are seeing as category creating opportunities, where the problem existed, but the solution set is completely new, and that's triggered by some tech development in technology. And so that's where I feel, you're really creating opportunities. Now, in some of those cases, the opportunity to commercialize this might still be a few years away, right? And that's where, there is always a risk of being caught on the bleeding edge instead of on the leading edge, right? And that could happen. And I've experienced that as an entrepreneur with MCheck, for example, right? We're probably 5 years too early with mobile payments. But eventually the problem did get solved, right? So those are, of course, higher risk, higher reward situations that entrepreneurs play for. And unfortunately, in many of those cases, you only find out whether it was leading edge or bleeding edge post facto. It's very hard to predict it upfront. And that's what makes entrepreneurship so exciting as well. But if you're a founder that's working on an idea like that, other than talking to us, I think the best advice I would give is whatever you're doing, stay in touch with the customer, right? And really understand if you're solving a problem that, as difficult as it may be, people will actually want the solution if you're able to pull it off, and really be ultra frugal, right? These are companies that are built over long periods of time, and running out of capital is not an option.
Yeah.
So that's my view. I'm sure Amit has some thoughts on this as well.
Yeah, I completely agree with you, Sanjay, that technology disruptions are the biggest thing. Everybody's probably hearing now about language learning models and chat GPT, or about artificial intelligence, or maybe about 5-7 years about mobile internet, at least in the Indian context. So that for sure, if you're doing something in the tech space, you got to keep an eye on that, because they just leapfrog typically once in a decade, or if not more frequently. The other twist I would add is consumer behavior change, right? So what is happening, even if the technology is unchanged, but like people are suddenly, for example, post UPI coming about, or QR codes coming about, or mobile internet coming about, or videos becoming more popular. In what way has that consumer behavior change lent itself to new opportunities? So that's the other area that I would look for solving interesting new problems, or problems in new ways.
Got it. And so next is like from opportunities to startups are for long-term gain. So our next question is from Avinash Bhaskar. So he's asked, how can startups realize they're built for the long term until profits are made? For example, in public equities, profits, ROC, etc. serve as validation for competitiveness and more. So what serves as validation in loss-making startup?
Yeah, a great question, Avinash, and a tough one. So obviously, there are many different markers to figuring out if a startup is getting product market fit and eventually has some defensibility and some moat. My simplest, very almost naive metric is organic traction. Are you getting organic traction without having to pay the likes of Google and Amazon and Meta to get distribution? That's one very good indicator. Why is that a good indicator? Because it means that the customers are pulling your product. It means that you've really built something that people want, and you don't have to market it per se, right? And I know it's a bit of a nirvana or a dream, so there can be some rules of thumb. So typically for a consumer startup, if you can get 50% organic traction, you're probably in the top decile, if not the top 5% in the world, right? If you're getting that. For a B2B startup, perhaps similar, right? Depends. And this is not an absolute rule. It matters how long you've been in the market, whether your category is a little bit established or not. But I think organic traction is one very good one. A close second, I would say, but is somewhat related, and particularly more so in B2B, is referrals. So what percentage of your customer book is coming from referrals, right? It's also true in consumers, where it takes time to build a brand. So that's one very, very important one. A third, which a lot of founders shy away from, particularly, I would say a little bit sadly in the Indian ecosystem, is pricing. So Warren Buffett has this beautiful quote that the best power, the best powerful brands are ability to raise pricing without having customer attrition. And so our third partner, Shripati, has a beautiful blog on this as well. And something to the tune of like, keep raising pricing till it hurts. And our founders typically keep discounting till it hurts, right? So I think the point is, if you can raise pricing and the customers are still willing to pay for it, that means you have some brand promise you're delivering. That means you have some real customer value prop that you're delivering. That means you have a superior product compared to competitors so that other people are willing to offer stuff. But it's a harder question at early stage. I admit that, Avinash.
Sure. So now we have perfect question. The next.
I'll add a couple of examples to Amit's thing, right? We had one company in our portfolio that I can't name right now that had a product which was sold on a per user basis, and they were initially charging 50 rupees per user per month. And then we said, let's do some experiments and see how far we can push it, right? And rather than waiting, we said, every customer we meet, we're going to double the price and see where we get pushback, right? And it went to 100 rupees, it went to 200 rupees. We had no pushback at all. And then when we tried 400 rupees a month, that's when we did get some pushback. So that's how we settled at 200 rupees. And then the next week we said, what if we tried a 10 user minimum, right? And now you saw their ACV going very quickly from 50 rupees a month to 2,000 rupees a month, right? So I think founders are scared sometimes to push the lever of pricing. And I think that's the blog Amit was referring to. And sometimes feel that they need to prove their worth, right? But they're not realizing what the value is to the customers. It's most important to understand what the value is to the customer. And if, for example, that company had seen pushback at, say, the 100 rupee level, it would have been clear that it probably didn't have a viable business, right? And so it's very important for founders also to establish early in their journey that they do have at scale a viable business, even though in the beginning they might be having like a high cost of sales, for example, right? So that is one part. And to give you a very extreme example from my days in Silicon Valley, I was in a large sales meeting. We were discussing $1 million contract, and the customer kept going back and comparing the competition. And the VP of engineering just blurted out saying, if the price was $1, would you buy our product? And we were just negotiating $1 million plus contract. And the customer was stunned and said, of course, right? But what we established by that question was, okay, you want our product, not the competition, right? So the moment that was established, then we said, okay, now we're only talking about pricing. We've eliminated the competition from this discussion, right? So I think founders should very early validate, are we winning and what's the value to the customer? And then after that, pricing settles itself very quickly.
Got it. So I think next is a perfect question to balance this one. So like how to beat discount wars. For example, if you're selling an item for X and a big player comes in and launches similar product at 90%, so how does a startup compete with them without getting bankrupt?
Or the big player comes and offers to buy your customers out and pay the customer a lot of money to get you out of there, right? We see all of those things. Personally, my view is that you just have to ignore it. If you have a really good product and really good value to the customer, and if it's a large opportunity, there is space for everyone, at least certainly in B2B environments, right? I think consumer plays, Amit will probably be better suited, but I think businesses at least make decisions on a variety of reasons, not just cost. And I think as long as you're scoring very highly in all of those factors, you'll build a successful company.
Yeah. So I was going to just say that, look, another thing you need to do very early in the journey is doing your customer discovery and your ideal customer profile. So are you clearly adding value to that customer to be able to, for whatever quality that you're adding, whatever quality of customer service, quality of product, etc., that they're willing to pay that pricing. There's a beautiful framework on pricing, although it's becoming like a pricing episode, but it's relevant, which is that at what price does the customer feel like this is great value? At what point do they feel like this is too cheap almost and too discounted and therefore not really sure of what you're going to get, and vice versa? At what point is it too expensive that they would never pay for it? To look to Sanjay's example of the $1 million versus $1, right? Or $10 million for that same enterprise software. So I would say that just doing that discovery is very important. And there are times when if you get a heavy duty competitor who is extremely well capitalized and is just out to just burn kind of the bridges or the boats, that you may have to find another spot of customers or another kind of quality of offering, right? So you might go mid-market, you might go enterprise, you might go, there's a particular niche because competition is always going to be there, right? It's not, especially if you're in a market where your product is not that dramatically differentiated. So I would say you shouldn't hesitate. I mean, there's no way you should try to compete on pricing, in my opinion. But at the same time, I think you should also not be afraid to notionally walk away from certain segments of the market, because not all revenue is good revenue, right? So if your customer just took you in a flippant way and all they really cared about pricing, but not really whatever your USP was, then you're already going to fail the pricing test, right? The Warren Buffett test saying, can you keep increasing pricing every year and customers still pay for it? So I think the answer will be a little bit mixed, right? That sometimes you do have to go to find new customers, and sometimes you have to let customers go.
Got it. So now for pricing, we move to product and distribution. So the next question is, like SaaS companies invest equal amount in product and distribution during the initial years, but when does the company shift focus on distribution?
So there's this beautiful quote that I heard somewhere. I think it's, I forget who it is from. I think it's Alex Rampel from Andreessen Horowitz when he was doing his startup, right? Which is that, the journey of startups is, can you get distribution before the incumbent gets innovation, right? So let me repeat that. Can you get distribution as a startup before the incumbent gets innovation? And I feel that by and large, we tend to grossly underinvest in distribution and overinvest in product. Now, of course, that's a very broad generalization. And as Mark Twain said, all generalizations are generally wrong, right? So please take it as a grain of salt. But I would say a lot of this depends on your DNA. If you're an engineer or a product manager, you'll typically tend to want to just build, iterate, feature, add, remove, whatever. If you're a sales, marketing, business type of founder, you might just want to sell, and forget about building. So the right answer, as everything else, is to have a balance. I think the days of just building product or just doing sales and marketing are over, right? I mean, and you can see those lines blurring. This whole notion of product-led growth, this whole notion of being customer first, doing customer discovery, even the whole lean startup movement, which started 10, 15 years ago, is all around the fact that do customer discovery, spend enough on distribution, spend enough. We've already covered enough today on pricing and potentially packaging. So I would say just having a balance is very important. Just do a self-assessment on, are you over-indexed on product or over-indexed on distribution, and just do a little bit of counterbalance. Because very rare is it the case that, and whether it does happen, right? There's no doubt that it does happen, where you only invest in product and it works like wildfire. That's the exception that proves the rule, and vice versa, that you're only looking at distribution, but have no product, no business model, no unit economics, etc., and then you'll be successful. So I would say 50-50 is a dream, but I would definitely say most startups will probably be 90-10 or 80-20. Figure out which side you're over-indexed on, and then balance with the other.
Got it. Sanjay, your thoughts on this?
Yeah, I'll give an example of Quizzes, which is a company now with 60-70 million monthly active users, and we were privileged investors in this company, and when it had less than 1,000 users, right? So that was a company over the last 5 years that just grew just by building an amazing product. The net promoter score rarely dropped below 80, every time we would meet them, they were growing 30% week on week at one point, right? So those are some situations where you get the dream product right at the beginning. It doesn't happen quite often, and when it does, you should enjoy the journey. But I have to say that I have never heard of their servers going down, for example, right? So it was not just that the customer experience was great, that the product, it was delightful, that it appealed to people. It just worked, right? And I think one of the most important things here is that you have to have a very robust product, and it has to do what it claims to be doing, right? When you get to B2B, especially in SaaS, very important that people don't buy products, they buy relationships, right? So businesses are looking at you as a way to become their operating system for their business for the next several years, right? And so they have to trust you as a founder that you are going to do right by them over a period of time. That's what they're buying. So in some ways, product and distribution, as Amit said earlier, are very intertwined here, right? Because what you have is definitely not exactly what they need in its entirety, but there's a promise that, if I partner with this company, they are over a period of time, I can trust them to solve my problem. and really deliver the right solution over a period of time. So that's where, again, this whole distribution, customer relationship, engagement, and product have got to work in it's sort of like two steps that you can't just go forward with your left foot. You have to also advance the right foot, and they are in lockstep with each other.
Got it. Next, we have Pooja, who has asked a couple of questions on fundraising. The first one is, how to say no to few potential investors when your fund is oversubscribed? Sanjay, what's your take on that?
I say you never say no to investors, especially in this time and age. Take all the money you can get. I think it's important that investors also are pragmatic people. They understand, dilution for founders is a sensitive matter and have to be pragmatic about it. Yet at the same time, I think look at on a more serious answer to that question is look at, what is this person bringing beyond just the capital, right? And if you think this person, yes, your round is oversubscribed, but there is this amazing investor who has very specific knowledge about the domain, is somebody that you have, that you think you can learn a lot from, that can add a lot of value to you, then making room for them on the cap table to accommodate them is more than just a financial decision, right? So I think that's what I would suggest, make room based on whether it's if it's just for the money, probably not, but if there is a lot more intangibles, then it's worth keeping that investor on your cap table. The other thing is, while companies raise rounds to get to certain milestones and get to the next stage of growth, you don't have to wait till you're out of money before you raise the next round, right? So you could raise a round and then let's say there's this amazing investor that comes. You could, as you start progressing, decide to accelerate your growth and then go back to them, right? So staying engaged with them is probably the best way to keep them in your orbit without necessarily having to take their money immediately.
Good. Amit, what's your take on that?
No, I would completely double click on the last thing that Sanjay said, that just maintain the relationship. You may genuinely not be able to accommodate everybody in a particular round, especially if you're doing something great and there's a lot of interest. But I think maintaining relationships across rounds is very important because you don't know how the market changes, dynamic changes. You may want to partner with one of their other portfolio companies, etc. So I think you should find a way to stay engaged past this transaction.
Good. So next we have a post-fundraising question. And the question is, how can founders practice financial discipline in running the company and managing people expectations after a large fundraise?
Yeah, I think the answer to that question is what happens before the fundraise, right? And back to a little bit of the culture question we discussed earlier. So I think if you're all building for, the long term and for building a large defensible company, for building a large company that's going to change and have an impact in the universe, right? I think people understand that, a large fundraise is fuel to accelerate that growth and not necessarily money to distribute for salaries or nice offsites or, fancier new office digs, whatever. Some of that is fine too. But I think that just setting the vision early on to say, hey, look, what is our ultimate goal, right? What are we trying to get to? Not to over-index on our portfolio company, but like Quizzes, they want to get to 1 billion monthly active users. Now, if you're in that Quizzes team and you're every day thinking and dreaming that we need to get to 1 billion users and be one of the few things in the world which are at 1 billion users, maybe less than a couple of handful, or certainly maybe a couple of dozen, then yeah, even if you do a large fundraise, your first thing is not like, okay, can you triple my salary or double my salary, or can we get a fancier new building or whatever it is, right? So that would be one thing. I know it's a little cliched or whatever. The other thing is also depends on the culture you're building. What is the level of transparency, right? Because these days you want startups to have at least 3 years of runway as opposed to the usual 18 to 24 months, so that that you won't have to go through unreal times, whether it comes to layoffs or pay cuts or whatever, right? So you don't want to overinflate your payroll book in terms of either number of employees or whatever, and just still continue to be lean as a startup. So I think to summarize, I would say be transparent, ensure that everybody is aligned to the long-term vision of what you're doing and what this new fuel that you're raising, where are you planning to deploy it, right? both on the offensive side in terms of expanding your charter and growing and so on, and on the defensive side to make sure you have enough runway. And I think most employees who choose to work in startups, who are really aligned for the longer term wealth creation and the longer term impact, rather than any sort of near term immediate kind of gratification, if I may say so.
I'll just add one
Right.
sentence there. I found that most of the companies that have raised large rounds suddenly end up being ultra frugal right after that. So that's a good sign in general.
Got it. I think next question is somewhat related to this, like, so how to avoid bad hiring decisions?
Yeah, I would say that by and large, people do a good job of hiring and scrutinizing and pruning and understanding for skills, which is what is your core competence, what are your skill sets, does that work, whether you're a good engineer or a marketing manager or social media person or whatever. I suspect a lot of people don't spend enough time on the culture fit, right? This is not the only mode of failure. There are many, but this is one that comes to top of mind. That how much time are you really spending trying to get to know them and whether they fit your culture? And a few tips, sort of unsolicited, are hang out with them in a social setting. Hang out with them, even if they're going to be a manager or an AVP or a VP. Have them meet with people that are going to report to them, which is deemed to be very harakiri and almost non-intuitive, but it actually works amazing, right? So if your culture is that of being more egalitarian and inclusive, and there's somebody with a big chip on their shoulder, maybe they won't fit, right? Maybe they'll manage upwards well, but they won't be able to manage the team and take them along, right? So I think just spending a lot of time on culture fit, on the values, and really, you can't ask somebody like, hey, do you believe in inclusiveness? Of course I believe. You believe in this, right? You have to really probe, and that is one. And the other that I think is a pet peeve that I see even at a unicorn level of hiring. This is particularly more relevant for senior leaders, but I think it would be true for all levels of the org, is people do a very lousy job of ref checks. So once you've done all the hard work on skills, saying, oh, Shikhar is a great person and seems to have good references, and it was nice to have a meal with him and go for a walk. This is done now. But you know what? Like, you could really fake it in an interview, right? Or you could be off. You could be having an off day in terms of your sixth senses. And so I personally don't delegate any ref checks. And I would encourage at least founders. I mean, I think there's no reason to delegate anything until you're 200, 300, 400, 500 people. But especially for CXOs, I don't think you can ever delegate it, or senior leaders, right? So you need to at least do 3 to 5 ref checks and don't delegate it to quote unquote HR or talent acquisition. So those are two things I would say, but these are not the only modes. It's a great question.
Yeah. I'll add a couple of things that happen post the hire, especially for senior hires, right? So obviously you want to do the best job coming in, but the fact is there will be hiring mistakes made. And hiring mistakes actually hurt both parties, not just the company, but also the employee, right? Because they're just in the wrong place and it's just not working out. I encourage all founders to always bring their senior hires to, at the latest, the second board meeting after they join the company, and have them present to the board, right? That gives a good, first of all, it gives them a lot of confidence that, their work is being recognized and appreciated, not just by the management team, but also at the board level. And secondly, the board, might identify sometimes, certain challenges with the person, perhaps in terms of their expertise, perhaps in terms of how big they're thinking, and there might still be an opportunity to correct that, or it might just be the wrong hire, right? So I think waiting too long and hoping that somebody, frankly, I think if people don't hit the ground running at senior levels in a startup, it's a problem. And definitely, if in 4 to 6 months you're not convinced, it is time to part ways, right? So it might sound harsh, but it's actually right for that person, and of course, right for the startup. So these are things that, again, people should not be scared to make difficult decisions, right? And yet at the same time, obviously not be trigger happy to make these decisions.
Great. Thanks, Sanjay, for the answer. Like, next, we'll move to the last question of the day, which is a very question of the times. Like, how important is building a public for founders today? And any tips on that?
Yeah, so I think it's a great idea, and obviously it will not work for every company and every startup, right? If you're doing something, in deep tech, or genuinely some kind of stealth reason in terms of you have a distribution hack or something that you don't want to share, that's fine. By and large, there is a lot of camaraderie and support, not just from the entrepreneurs, but also investors like ourselves and our fellow investors in the ecosystem. So we are constantly looking for any signal from all the noise that is out there, right? I mean, obviously social media is inundated with too much gyan, but I think there's, unfortunately, I think very little gyan about actually building and learning. And one of the things we look for a lot, at least for when we're investing in entrepreneurs, is what is your learning loop? What is your iteration loop? What is your launch speed? What is your iteration speed? So if you're building in public, a lot of that is out there in the public, right? It's not a static resume on LinkedIn, if you were to take a hiring analogy. So I'm seeing, okay, what did you try? What worked? What didn't work? What have you adapted to? What have you done? What mistakes have you made, etc. That is priceless. That will not come out in a 2, 3, 5-hour dating process or 2, 3 meetings over a couple of weeks to make a decision. So I would encourage it. Obviously, like I said, with caveats that, if there are certain stealth things that you really don't want to share or don't share, that's okay. I think that's totally fine. So yeah, I mean, my broad recommendation is do consider it. And you'll be surprised at how much input you get. By the way, sometimes even the negative or the constructively critical input you get can be very helpful. This is the whole religion of open source, right? Things like Linux and Android and others are built on this, because somebody else sees something, you're doing something absolutely wrong, saying, hey, this is not the way to do ESOPs, right, for employees, because you'll get stuck with this tax later. Or, if you're flipping a company from India to US or US to India, hey, have you thought of this? Or do you know that other challenge that happens? So you might actually get constructively critical feedback, which is not just, rah, Shikhar, you're doing a great job. But this is crap. This is not going to work. Then you better now than later, right? Like I said, this is the open source movement, which is worth hundreds of billions of dollars now. So anyway.
I think my view on that is it's really, you can't change the DNA of the founders, right? So if you're fundamentally an introverted founder, who's more of a thinker, who doesn't like to socialize a lot, you're going to be completely out of your comfort zone trying to build in public and suddenly share everything which you consider proprietary IP, right? So you can't fundamentally change the DNA of the founders too much. And I think to each his own. We have seen some of the largest companies in our portfolio, and these companies have got to monster scale and have never done a single press release or any PR about themselves, right? So, and yet at the same time, you have companies which are very, very young, but that are building out in public. They're talking about everything they're doing, getting feedback from the audience, and actually building their product with the feedback loop, right? So there is no right or wrong here, but most importantly, stick to what you're comfortable with as a founder. Push yourselves a little bit, but don't sort of fundamentally change what you're doing, because that's too risky an experiment.
Got it. So that's all from the episode today. Thanks, Amit and Sanjay, for joining us today. And thanks to you, listener, for tuning in. And if you have any questions about startups and entrepreneurship that you want us to cover in the future episodes, you can write to me, shikhar@primeview.in, and we'll cover in the future episodes. And you can also find a link in the show notes where you can post your question. Thanks for tuning in. See you next time. Bye-bye.
Dear listeners, thank you for listening to this episode of the podcast. Subscribe now on your favorite podcast app for free, and you'll be the first one to know when new episodes are available. Just search for Prime Venture Partners Podcast in Apple Podcast, Spotify, Castbox, or however you get your podcasts. Then hit subscribe. And if you have enjoyed the show, we would be really grateful if you leave us a review on Apple Podcast. To read the full transcript, find the link in the show notes.